All right, Matt, the mortgage guy here. Want to record a video talking about CFPB, Consumer Financial Protection Bureau's latest proposal to mortgage servicing. Their attempt to prevent a wave of foreclosures. What does this mean to you if you're in forbearance? What does this mean for the housing market? How is it going to work? How might it shake out? I'm going to answer all those questions in this video. I'm going to talk about how modifications and whatnot worked back in the day, because I was involved in a modification myself, and I know hundreds of people that I've talked to that have done modifications, and so I'll share in this video my predictions for how they might manage this thing, and more importantly for everybody else who's not in forbearance is how is this going to affect the real estate market? How is this going to affect you as a consumer that might be in the market to buy real estate? Because I think that's what a lot of my listeners want to hear, and questions I've got over and over again. I appreciate all the comments on the different YouTube videos. Quite a few people told me, hey, Matt, what do you think about the CFPB's latest proposal? One, I think that we can use a stronger word than proposal. Basically, they put this out and they want comment to tweak it. But this is coming. This is inevitably going to be something that the CFPB puts in place. And I'll tell you my thought for why. And this kind of ties into maybe my first point, which is, what is this? This is the CFPB saying, we know what happened in the last housing crash. We know how painful it was for homeowners, for banks, for investors, for everybody. It was ugly. It was messy. Foreclosures in some areas were taking 18, 24 months. These houses were sitting vacant. It was, an eyesore for the neighborhood. It was dragging values down. The banks were losing money because they weren't getting paid on these loans. The homeowners were losing money because, their credit was ruined and they were getting dragged through it. It was really nasty and really ugly. So the CFPB basically is coming out and saying, just making sure the mic's on. The CFPB is coming out and saying, we are going to do all we can to avoid that. And they're doing it knowing that this fall, and it keeps kind of getting kicked down the road, millions of people are going to be coming out of forbearance. And one important note to make is for anybody who was counting on some sort of market correction or some housing crash, because we'd see 2.5 million, 3 million, whatever number is the latest number that you're using for your case. We see all these people coming out of forbearance in 2021. We're going to see a market crash. We're going to see tons of inventory. You can pretty much just wipe that off the table, because even though 2.5 million people were exiting and only 10 to 20% max were going to end up in a very bad position where they might have to foreclose, that number, you can count on it being less than 5% because of what the CFPB is doing. And so I won't read this word for word, but it just talks about the pandemic and how many people were hurt, high volume of people exiting forbearance, and they're going to try to put in some guardrails. And the guardrails they're going to put in is they're going to basically tell servicers, this isn't going to be a, hey, we suggest. This is going to be a, you're not allowed to foreclose before this date. And they're tentatively saying, let's call it December 31st, 2021. It might be a later date, but they're saying, instead of getting rushed into foreclosure and tons of people exiting forbearance and going into foreclosure, there's going to be a period where you're going to have to, review things, and you're not even allowed to foreclose until this date. And so the option part, which is the next part, is they're going to tell servicers that it's funny too. It says permit. We're going to permit servicers to offer certain streamlined programs. It's going to be a little bit more than permit. And last time around, I can tell you, 2008, 2009, it was like only certain banks were offering modifications and they were allowed to, but they weren't. Then it became you must do 100 million. You must do 250 million. You must do $1 billion. In modifications, whatever those numbers were, they were telling individual banks and servicers, you have to modify this number of people, because it was a stress to the system. It was nasty. It hurt consumers. It hurt banks. It hurt everybody. They've learned their lesson. And I talked about an interview earlier where they might overcorrect this time and do too much, but that's better than doing too little, right? And so servicers are going to be required at some point to give options. And I don't know. Oh yeah, with certain exceptions, they're required to give a borrower all these options. But last time around, it was similar, where or it wasn't like this is the specific program you've got to do, or this is that. Like different servicers, different loan modification programs varied. Some of them extended the term, some of them lowered the rate. I know from one that I was personally involved in that they basically had you show your hardship, show your verifiable income, and then they did some math to get your payment to a certain percent of your income. And so they had to figure out a rate that would make that work and a term. And so I don't remember, was it 40 years and it started at 2% interest rate? Sweet, sweet loan mods were happening back then. And this is essentially what they're proposing, implementing, is that people are going to be presented with and allowed to do loan modifications. You're in forbearance, you owned a restaurant, the restaurant, had to go out of business because you just weren't able to operate, right? Especially if you're in California like I am, some businesses through no fault of their own were kind of pushed out of business. And so what this is going to allow is you come out of forbearance, you don't just start paying your 4% or 3.5% that's got 26 years left on your mortgage. You might get to modify it, go to a lower interest rate and a longer term, lowers your payment by $500. Now you're not foreclosing. Now it's not a cost to you, ruined credit, foreclosure, banks out because they've got to collect. They've got to, wait 6, 9, 12 months for the foreclosure process. Everybody wins for the most part, right? And so that's the type of stuff that they're basically putting into this bill. Another thing that's important to think about too is this talking about racial inequality. If you look at the numbers for forbearance and you look at loan type, FHA, VA, and some of these loans that by the data will show that, a demographic that may have a lower credit score, a lower income. It might be a Black or Latino community, not necessarily always the case, right? But these people are 2 times as likely to be behind on housing payments. That's what this says, right? As of December 2020. And so there's more of them in forbearance. If we foreclose, we're going to widen an already wide gap. We're going to look at Black and Hispanic homeownership rates versus other groups, right? And so it's a good protection to have in place. It'll be interesting to see how it all unfolds. They want comments in by May 11th, 2021. So that's really only like 5 weeks away, right? Get your comments in, and this thing is going to be live. The only other thing I think I would want to add is that know that this is going to keep a lot of people in their home. And when they do a modification that goes to 40 years and they've got a great interest rate, it's saving them from foreclosing. It's keeping them in their home. But what it's also doing is landlocking certain people to not be moving and turning over, which creates inventory so that somebody else can buy. So our already low inventory environment where we've got not enough houses to sell and all these buyers looking for them and home prices are going up 10, 12, 14%. This is going to exacerbate that problem more than it's going to help. It's going to help millions. And so I'm not going to knock it. I'm just saying if you're looking at real estate and you're hoping for a real estate crash and you've watched YouTube videos that talk about when forbearance ends, watch out, wave of inventory, home prices are coming down 20%, this along with unemployment, along with this, whatever they say to try to make a case for a market crash. This was a big, big thing that the people that were predicting a market crash were using. And this is pretty much off the table. Forbearance, like I've said in many videos, the vast majority of people that I talk to on a daily basis as a mortgage broker aren't experiencing pain. They're in forbearance in order to bolster their savings, pay off other debts, or for other reasons. The 15 or 20% of people that truly need it are going to be saved. And I appreciate that. The other 80%, there's going to be some extra froth in here. They might get a loan mod, and depending on how much proof they need to show to get one of these loan modifications, it might lock them into their house, prevent movement and inventory from coming to market. So it'll be interesting to see how it plays out. But this is something that no doubt, if you want to take one thing from this video, it's going to have the opposite effect of what people thought before, where flood of inventory, prices coming down. This is going to do the opposite. Lock people in their houses, prices go up. So real estate is really, really looking like the next foreseeable future. It's going to continue to increase in value. Hopefully not as much as it has these last 2 years, because that's not sustainable, but 5-6% appreciation next year and the year after is not unlikely. Hope this was helpful. Let me know if you have any questions. Matt, MATT @mattthemortgageguy.com. Thanks.